Welcome to Berkshire Taconic Community Foundation's Investing for Good webinar. This is an opportunity for you to receive an update on the Foundation's investment program that provided over $26 million in investment earnings to over 500 charitable organizations and funds at BTCF last year. We serve a diverse footprint covering Berkshire County, Massachusetts, Columbia County and Northeast Dutchess County, New York, and Northwest Litchfield County, Connecticut. The investment program provides resources to donor-advised scholarship, agency, educational enrichment, relief, and many other types of funds that made over $17.5 million in grants and distributions last year throughout our communities. I am pleased to introduce to you Liz Hilpman, our investment committee chair, and our consultants from Prime Buchholz and Associates, Tom Lupon, Tim Jarry, and Chris Shaw, who is not able to be here with us today. They will describe how our investment program works and generates superior returns for our charitable funds. Liz will give you an overview of our investment program now. Liz?
Okay, thanks, Joe. So the goal of BTCF's investment program is simply to generate strong returns with moderate risk that outperforms our benchmarks and our peer groups. Importantly, we want to earn returns that preserve the purchasing power of the portfolio, i.e. stay ahead of the rate of inflation. The way we do accomplish this for our donors is we have three investment options. The first is the managed pool, which is our primary investment portfolio, and it is invested with a long-term horizon and follows a classic endowment model portfolio framework. It's a very highly diversified asset allocation portfolio, and it continues to do very well and outperform marketable benchmarks and our peer groups. Prime will give you a more in-depth discussion of how that pool and the others are managed. A second choice is our socially responsible investment pool, aka SRI pool, and it is a portfolio that prioritizes socially responsibility in their investments there. And then finally, the third is our income pool, which is designed to offer, has a very low risk and provides modest earnings, but it is also available for those who want to be in a more risk-averse portfolio. The role of the investment committee is critical to how we manage the BTCF's portfolio, but we don't do it alone. And we work with Prime Buchholz Associates, which will, as you know, we'll be talking in a few minutes. This is an outline of the current members of the investment committee. They are extremely experienced with, they all bring a very specific set of investment skills that when we pull it together, we have a really great, robust and rich discussions that allow us to identify investment managers and investment strategies that ultimately give us the long-term strong performance that we've had over the years. We can't do this without our investment consultant, Prime Buchholz and Associates, and we have two senior members of the team working with us here today. I'm going to pass this over to Tom Lupon and Tim Jarry at Prime Buchholz.
Great, thanks, Liz. Pleased to have the opportunity to describe a little bit about ourselves, our firm, and the role we play with the Community Foundation. Just quickly, by way of introduction, Tom Lupon with about a quarter century, 25 years of investment experience, about 18 of those with Prime Buchholz, and have been advising the Community Foundation for the better part of 15. Tim, you want to give a couple background bios?
Yep. Tim Jarry, also a senior consultant at Prime Buchholz. I co-head our OCIO and education groups, and also work with a number of community foundations. I've been with Prime Buchholz for about 3 years and spent the 20 years prior to that at the College of the Holy Cross, where I most recently served as Chief Investment Officer and Assistant Treasurer. So with that, maybe I'll turn it back to Tom and we can get into the discussion.
Terrific. So we thought what we would do is offer a little bit of perspective on the current market environment. What you're looking at here is an exhibit that displays the near and long-term performance outcomes of some of the major asset classes, including U.S. and non-U.S. stocks, real estate bonds, and cash. A couple of obvious observations. One is the excess return offered in the U.S. market over all time periods measured. The second being perhaps the kind of underwhelming returns offered by other asset classes outside of the U.S. equity market. I think it's important to observe that, as most investors understand, while this relationship looks pretty consistent, that is the excess return in the U.S. market compared to other asset classes, we all understand that markets can move really quickly, and we caution against extrapolating these outcomes too far into the future. But again, just a little bit of perspective in terms of near, mid, and longer term performance of some of the major asset classes available to the Community Foundation. The next page describes one of the more important factors that the market is trying to understand and digest. As we all know, markets, generally speaking, assess and incorporate all available information. And at the moment, markets have an acute interest in the direction of interest rates. This exhibit plots out the Fed funds rate, or essentially the risk-free rate, over the last kind of 9.5 years, offers up a projection over the next kind of 1.5 years. And as you can see, we are expecting 2 rate cuts in the back end of 2024, eventual additional rate cuts into 2025 at the moment, perhaps landing at some normalized rate environment somewhere around 4% from a risk-free standpoint. And kind of generally speaking, a declining rate environment is supportive for stocks and other longer duration risk assets. And that's going to be important when we think about the way that the Community Foundation is currently positioned. The next page kind of describes another way of looking at kind of the rate environment. This is the plot of the U.S. Treasury curve, basically offering up a perspective on yields at various tenors or duration of particular securities available to investors. This plot also takes into account the direction of rate expectations, both mid and longer term. And what this is really describing, given kind of the differentiation between where the curves were at the beginning of 2023, 2024, and after the first quarter of 2024, is that we're in a pretty significant transition period from really abnormally low rates to something that is more normalized. And what we're experiencing now in terms of some of the volatility in the market, the losses experienced in 2022, the significant gains experienced in 2023, really reflects kind of some conflicting signals as we go through this transition period in the overall rate environment. Take a little bit of a step back and kind of reinforce who Prime Buchholz is and the role that we play. We're going to get more into the numbers and some of the outcomes of the Community Foundation as Tim takes over. But just as kind of a reminder, Prime Buchholz is a leading investment firm with a specialized expertise in the nonprofit community. We've got about 140 people operating out of 3 different offices, Portsmouth, New Hampshire, Boston, and Atlanta. We advise over 250 clients and close to 80 billion in combined assets under management. And in addition to Berkshire Taconic, we work with around 15 other community foundations, including Boston, Rhode Island, and the Greater Worcester Community Foundation. Our philosophy, which is incorporated into the Community Foundation's portfolio, is described in this exhibit. The key elements of a philosophy, or our investment philosophy: number one, be comfortable with return volatility associated with equity investing. We believe equity investments are where investors are most highly compensated for the risk available. The second tenet of our philosophy is to access alternative assets or differentiated sources of return for diversification purposes and risk management purposes. We typically include discrete hedges in our portfolio to protect against disruptive scenarios. These can be to manage volatility of returns, as an example, or to provide liquidity when necessary. And then with respect to the Community Foundation and other like-sized organizations, we encourage the Community Foundation and other like-sized organizations to take advantage of some of their advantages. In this case, you've got a very long-term horizon in which you're investing and a very sizable asset base. The long-term horizon offers opportunities for you to invest in longer duration investments, such as in the private markets. And the size and scale that the Community Foundation has allows you to access some really compelling investment opportunities that are probably unavailable to smaller and shorter duration investors. And then the last page I'll cover is kind of applying that philosophy to the portfolio at the Community Foundation itself. So what this table does, or this graphic does, is displays the actual allocation for the Community Foundation across the asset classes where the portfolio is invested, and then provides some expectations in terms of forward-looking outcomes for the overall portfolio. And in broad terms, what this display indicates is a meaningful equity orientation. The combination of public and private investments in the equity markets represent about 2/3, a little bit more than 2/3 of the overall portfolio. That's connected with the philosophy of being an equity-oriented investor, accepting volatility, accepting the liquidity risk, with the intention of getting compensated for those risks. This portfolio de-emphasizes fixed income. You can kind of see that at the bottom of the table, a pretty modest allocation to fixed income in the overall portfolio. It is a low returning asset class, but it does offer correlation benefits, typically negatively, or at least low correlation to the broad equity markets. And fixed income can also serve as a really important liquidity source when needed. We leave room kind of in the middle of the stack, or maybe at the bottom third of the stack, for long, short, and absolute return managers, representing around 20% of the overall portfolio. This is the scale benefit that the Community Foundation has in terms of finding and accessing some really compelling active managers in this category that will provide low or uncorrelated returns to the overall program while achieving equity-like outcomes. The table at the bottom of the page describes some of the expectations in terms of the overall portfolio. It's really important to note that the 5.9 and the 5.8% expected real return, this is over a long period of time. Obviously, we're not expecting to get that return each and every year. And also, it's net of any inflationary outcomes. So in more nominal terms, we're talking about expected rates of return in kind of the high 7s to low 8% neighborhood, which should be sufficient to offset inflation plus the spending pace on the overall program. And just kind of in summary, we think each one of our clients is unique and the portfolio has to adapt to the organization's expectations, risk tolerance, return objectives. And in this case, we feel like we've got a pretty well-designed portfolio that's, again, connected to the overall objectives of the organization, and should be sufficient to offset the return, the inflationary expectations, as well as the withdrawal pace from the overall program. Thanks, and I think we're going to turn it back to Tim to talk more specifically about some of the historical outcomes.
Thanks, Tom. Appreciate it. And I think, Tom set the stage here well in terms of how we think about things. And so the obvious follow-on is, so how has the foundation done with this approach? And the short answer to that question is quite well. And I think this is a real testament to the structure of the program and the people involved. So as you see here on the page, we have the performance of the managed portfolio, which is the lion's share of the assets at the foundation. And this is versus a relevant peer group, which is actually based off of a peer survey done of community foundations by the Finance, Administration, and Operations Group. That's the FAOG acronym you see there. And this is a group that surveys community foundations and provides support and sort of best practices between the groups. So a helpful resource. And when we look and compare at that relative size cohort of other community foundations across the country between 100 and 249.9 or 250 million, there are a little over 100 community foundations in that group. And if you look at the bottom right box here on the page, you can see that while the foundation trailed in the most recent year, and we'll talk a little bit about why that is, over the 3, 5, and 10-year periods, there's real excess performance over the average community foundation. And in fact, over the trailing 10-year period, Berkshire Taconic is the top performing community foundation within that group of comparable peers. And there's a number of reasons for this. Tom talked about a lot of them. There's a lot going on this page in terms of the overall performance attribution. But I think the important takeaway is that when you look at the average active weight, so the sort of risk that the committee is taking relative to the policy portfolio that Tom laid out, that they've added roughly 0.5% a year in asset allocation outperformance, and maybe more importantly, 1.3% in manager selection. And so not only are the asset allocation decisions been additive to the overall returns, but as Tom mentioned, the access that the foundation gets, particularly in active managers in private equity and within long, short, and absolute return categories, has been a real benefit to the overall returns of this pool. Now, just taking another step back, as Tom talked about, there are a couple of pools here. Liz mentioned them early on. The two main pools are what are known as the SRI pool, or the socially responsible investment pool, as well as the managed pool, which, as I said, is about $200 million in the lion's share of the assets. And the overall return goals of these two pools is the same at 6 to 7% per year. But how they get there is a little bit different as a result of the size of the pool and the underlying pieces. So you can see the asset mix is a little bit different. The SRI pool is allocated about 70% to equities and 30% to fixed income. It's a very liquid allocation that does not have exposure to private equity and flexible capital, or those long, short, and absolute return strategies that Tom talked about. And we'll talk about why that is, because it's a little bit difficult in those spaces to apply the screens that we're using to have this be a socially responsible pool. And then you can see that in contrast to the asset allocation that we see in the managed pool. The other difference you'll see at the bottom there is the overall pooled fee across the managers in the pool. Because there are no alternative investments within that SRI pool, you can see it's quite a bit less there, at a little bit less than 0.5% in comparison to 94 basis points, or a little bit under 1% for the managed pool. And again, we think that the net returns more than justify that fee difference, but it is worth noting. As you think about the guiding principles of these two pools, when you think about the differences within the managed pool, the overall goal is outperformance, right? There are no screens here. And so what we're trying to do is generate the best risk-adjusted return we can. To do that, we've employed a long-term strategic asset allocation, diversified across asset classes, as Tom mentioned earlier. And the goal there is long-term value creation. And so we have a very patient, focused approach, very diligent in terms of selecting managers and then sticking with them. And that has yielded pretty significant outperformance. Manager access, I think, is probably the biggest component of this within both the private equity and within the absolute return and long short categories. Because of the pooled nature of this fund and the size and scale, we're able to help the foundation access investment managers that wouldn't otherwise be available to some of the smaller underlying funds. And key to that is the participation in private markets. And again, here you can see at the bottom of the page that really compelling performance we talked about earlier. In contrast, also in the SRI pool, we're coming at this with the same approach to generate the best risk-adjusted return we can, but we're doing it with socially responsible criteria at play. And the goal here is to both restrict investment in areas that are not in keeping with some of the values and mission and values of the foundation and some of its constituents who select this pool, but also to look to have some positive impact. So you can see below there is roughly half the portfolio that is screened. We refer to these as bright line screens, meaning that the foundation controls the screens that are applied here. And you can see the screens listed down there below. I won't go through all of them. They're in two categories, one where they are 100% excluded from investment, and the other where if there's revenue in excess of 5%, they're excluded from the portfolio. The other half of the portfolio where we're using commingled vehicles and have less ability to apply the screens, we're still looking to invest with people who have mandates that are in keeping with these overall screens and intent of the portfolio. So as we look at how the two pools side by side have done for reference, you can see in the 1 year period that first bar is the managed pool, the middle bar is the SRI pool, and then the third bar is that peer group, the FAOG peer group of community foundations we talked about earlier. You can see that in the 1 year period, the managed pool underperformed that peer group, and that's because largely private markets had a down year, public markets had a very good year, and Berkshire Taconic tends to be overweight privates compared to some of its peers. In contrast, because the SRI pool is not investing in energy and some of those like sectors, it tends to be tilted a little bit towards growthier sectors like information technology and communication services, which have had a tremendous tailwind over the last year. So you will see these differences between the two pools. We still do think over the long term that they're both going to provide compelling returns. And you can see that over the 10-year period with the managed pool up a little over 8%, the SRI pool at 7%, so both in excess of that 6 to 7% target we've discussed, and both well ahead of the overall peer group at 6.1%. So we've talked about the long-term view, and we think that's one of the key pieces overall that's enabled the outperformance here. I think this chart is a great one to show, and we talk about it a lot, and I think it's in keeping with that long-term view. You can see in the bottom right is just an example. This is the overall investment of the S&P 500 over the last 20 years. And if you were invested over that entire 20-year period, you would have earned a 9.5% performance annualized over that 20-year period. If you missed only the 10 best days, that would be 5.3%, so a pretty material difference. And then if you missed the 50 best days, you in fact would have lost money over that 20-year period of time, despite the strength in the S&P 500. And so I think the real message here is that we want to maintain that long-term disciplined approach, stay invested to our targets, not try to make a lot of tactical calls or trade the portfolio heavily. And overall, that's been really accretive to returns. And then finally, the other thing, we've talked about the private portfolio. We'll note there's a lot of data on this page, but I'll draw your eyes to that middle bar. which is, I think, the key piece. When you look over the last 15 years, the private equity portfolio has added 15% a year. That compares to public equities over the same time of about 11.5%. So pretty meaningful outperformance of the foundation's private portfolio over the public markets, which is why this is such a key component of the overall strategy of the investment committee, and one that we think continues to add tremendous value to all of the funds that invest here with the foundation. So with that, I'm going to turn it back over to Joe Baker to let him give some concluding remarks.
Thank you, Tim. At this point, I want to thank Liz, our investment committee members, and our consulting team from Prime Buchholz for sharing this update on our investment program. As BTCF seeks to bring more resources to support the outstanding charitable causes throughout our communities, we welcome your questions or comments at any time, and you can reach me or other foundation staff at the offices and get our information as well as investment information on our website. Thank you for listening to the webinar today.